Welcome to Millennials, where this week we're talking to the Director of the IMF Africa Department, Mr. Abe Selassie. Sir, thank you for being on Millennials.
Thank you, Chris.
You're here to talk about the Sub-Saharan African Regional Report. A lot of detail goes into it, but we'll go roughly according to themes. And this year's theme, you've decided to focus on the quest for recovery. A little background information. Growth in Sub-Saharan Africa this year, 2017, is expected at 2.6%. In 2018, marginal increase to 3.4%. Now, generally, most of the growth is dependent on one-off factors such as relief from drought, commodity prices, and external factors. Very little of that growth is attributed to intentional fiscal management by our own governments. Broadly, economic growth through the region will marginally surpass population growth. But more concerning, income per capita is declining in 40% of the region's population. Thus, there are certain outliers punctuating growth. Economies such as Mozambique, Ethiopia, with positive growth rates. Now, generally the trend, though, is one of struggle at macroeconomic level and then compromised welfare at the micro level. Public debt has risen to over 50% of GDP in half of the region. All the countries with credit ratings have seen downgrades, some to below investment grade. Debt overhang. A lot of debt servicing costs are taking up national budgets. This is where the IMF is recommending fiscal consolidation and export diversification. Can you expand on that?
Thank you, Chris. Yes. So the picture, I have to say, remains difficult, but it's an improving one relative to last year in particular. Last year, 2016, growth was only 1.4%, the lowest it had been in almost 22 years. So this year we're seeing a recovery, but a timid one, as you pointed out. But nonetheless, it's an improvement relative to last year. So I have to say also, though, difficult as the overall pictures are, there remains a little bit of two Africas in terms of growth performance. So you do have very weak growth outcomes in commodity exporting countries, particularly the oil exporters, but you are seeing still fairly healthy growth rates in a number of the countries with more diverse export bases. So we have countries like Ethiopia, as you mentioned, Tanzania, Kenya, and East Africa, but also the likes of Senegal, Cote d'Ivoire, going well above 5% in most cases. So you still have quite a few countries that are continuing to sustain growth. But as you pointed out, one thing we are concerned about is the health of the public finances. In particular, as you highlighted, debt has grown quite significantly last couple of years. There's 3 points I want to make on this issue.
Okay.
I think the first one is this increase in debt has been across the board, as measured by the debt to GDP ratio, both in oil exporting countries where you would expect that because they've been hit quite badly by the decline in commodity prices, which has affected growth, fiscal sources of revenue. But we've also seen these countries that I noted earlier that have continued to grow fast. They too have been experiencing an increase in debt. And that shouldn't really happen when you're growing rapidly. The pace of debt increase should be modest, if at all. So that is across the board picture, and that's concerned. That's the first point. The second point, though, is an increase in debt in and of itself doesn't mean a country is in trouble. What counts is your capacity to service debt, and you mentioned a 50% of GDP debt level, for example. Whether that's problematic or not depends on how much you're collecting by way of tax revenues. So 50% of GDP debt can be borne much easier by a country that collects 25% in tax revenues compared to one that collects only 10% or less. So that is a very important distinction to make. Which brings me to my third point on debt, which is that, as you also highlighted, that we need to find ways to make sure that this debt picture doesn't continue to increase. And the way to do so is, or at least with regard to fiscal policy, is to make sure that you have smaller deficits. I mean, deficits have been an important factor driving up the debt. So countries need to strike a healthier balance between investing in tremendous development needs we have, infrastructure, health, education, and avoiding a debt build-up. So some recalibration is needed in fiscal policy, including a lot of fiscal reforms.
You're talking about basically your allocation of your fiscal spending. There's a theory which was quite interesting in your report, where you talk about a fiscal multiplier. And the general argument is certain targeted spending would be more potent to growth than other targeted spendings. So, for instance, you do recommend in one of the chapters trimming down on unnecessary or not so necessary subsidies in certain sectors, and maybe keeping spending in certain expenditures that are more society based. How does that fiscal multiplier help guide countries and governments into controlling their fiscal outlook?
Okay, so given that fiscal consolidation, fiscal reforms are on the agenda, what we did was to look at what is a way to do this fiscal reform in a way that doesn't affect growth. So that was the focus of this study. One thing we found was actually, and it's difficult to generalize because policy, appropriate policy differs from country to country. But one trend that we see, or one empirical finding that we found, which was quite robust, was that fiscal adjustment that is based on revenue mobilization tends to have less of a drag on growth than adjustment that's based on spending, on the spending side. So we are advising most countries, and also because tax to GDP ratios, tax collection levels are low, the thrust of our advice really is for countries as much as possible to rely on revenue mobilization in effecting the fiscal adjustment that they need to do. Now, within spending, the composition of spending also matters, of course. The more you do adjustment on capital investment, the more harmful that can be for growth. So other things being equal, you want to focus your adjustment on elements of spending that are more of a recurrent nature, things like the ones you mentioned, subsidies on fuels. We also find those kind of transfers tend to accrue, the benefits of that tend to accrue to richer segments of society relative to poorer segments of society. So there is a way to, for example, remove, in countries where fuel subsidies are taking a disproportionate share of the budget, there is a way to remove that and introduce targeted transfers to the most vulnerable groups that might be affected by the removal of this subsidy.
You made a distinguishing factor between resource-dependent countries and export-diversified economies. I just wanted to note, take Nigeria and Angola, for example, very dependent on oil revenues. Now, trace back to 2013-2014, where oil per barrel was at $119 per barrel. Within 3 quarters, it fell to $69 per barrel. That affected up to 80% of the country's revenues. Similar thing with Zambia, which is copper dependent. Now, you're advising export diversification to move away from that dependence. What strategies of export diversification would you advise for countries that are resource dependent to be more like the diverse countries?
Okay, so export diversification has been a perennial struggle for our countries in the region. We've talked about this for decades, quite frankly. But and we keep thinking that every time commodity prices are high, that this will last, and we lose sight of the importance of diversification, of course. And we've seen yet again how volatile commodity prices can be, and that extreme reliance on a single commodity, really you're leaving yourself hostage to things you don't control.
Yep.
So, again, we want to bring that to the front burner and, make sure that the thrust of policy work in countries like, Angola, Zambia, that you mentioned, continues to facilitate diversification. Again, the specifics matter country to country, and even within a country, over time, the required policies can change in terms of fostering diversification. But what we see works is first and foremost, addressing the main drivers of cost, or what is making countries non-commodity export sector uncompetitive. And, it tends to be things like lack of readily available electricity supply, access to ports, effective roads, effectively functioning ports. So this infrastructure side should not be underestimated. I mean, it can help reduce the indirect costs that exporters face, whether it's agriculture exporters, etc. So addressing that, I think, is paramount in most countries. The infrastructure side shouldn't be forgotten in terms of how much it can lower. Beyond that, there is kind of the policy environment itself, whether it facilitates quick investment decision taking, so that also is an important element.
You're speaking about export diversification. Exports assume there should be foreign markets which are competitively open to good, desirable products. Do you have any comments on the region as a whole, improving its terms of trade with export markets, securing more consumer bases elsewhere?
Okay, so, to some degree, I think there may still be barriers, but frankly, I think the main deterrent of lack of export penetration in most markets tends to be the lack of competitiveness of our goods. If anything, when you look at markets like the European Union, the US, I mean, you have initiatives like AGOA, which facilitate the imports of goods at preferential rates, and they're not being utilized fully. So again, the key, I think, is lack of competitiveness, and I think the barriers are of secondary order importance.
Speaking of competitiveness and desirability of goods, most of the goods that African countries generally look to export are of primary production. How can African countries in general move up the production scale, perhaps into manufacturing and services sector?
So I don't think there's a silver bullet for countries, but what we found, when we looked at case studies of countries diversifying their export base, what is interesting is that they've worked on their strengths. So a country like Botswana, of course, has diamonds. It exports diamonds, but has started increasingly processing the diamonds.
Moving up the value chain.
Exactly. Now, I'm not sure kind of, particular very labor-intensive form of manufacturing makes sense for a place like Botswana. Whereas that makes sense in a place like Ethiopia, which has very, large population, a lot of labor that needs to come off the agricultural sector. So more labor-intense manufacturing may make sense for Ethiopia. Or take a place like Uganda. They've worked to their strength, in terms of what we've seen, the emergence of agro-processing industry.
Yes.
Has been quite developing. So it really is the kind of strategy you want to follow to promote diversification is country-specific. And again, I would say kind of in terms of, for lack of a better word, industrialization or diversification strategy, we want to start with interventions that will facilitate the broad range of activities. So, any kind of modern activity requires ample supply of electricity, a good road network. So before you look to introduce tax incentives or very particular interventions, I think you want to make sure that there is a sufficient infrastructure basis in a country. Then you want to move to next, saying, okay, at least the basic services are there. What is the next thing that's stopping the emergence of new industries? And then do more specific and targeted.
Most of the industrial policy recommendations that you're placing have an emphasis on infrastructure. Now, infrastructure tends to be huge capital-intensive projects. Now, those are more of a long-term horizon. And one of the things that attracts the kind of investment flows like that are certainty of governance structures. Now, in not less than 5 countries within the Sub-Saharan region, the elections either going on or will go on within the next season. Zimbabwe in 2018, South Africa, Malawi, currently in Kenya. What does electoral certainty do to encourage or discourage that type of investment?
So, I think there's a bit of a double standard here. I mean, democratic turnover of governments, the electoral processes are part and parcel of the democratic process that our countries have transitioned to. So I don't put as much focus on that as I do on policy uncertainty. making. I think most investors accept that, in countries where democratic processes are in place, they know that there's going to potential for change in government. But really, it's more the policy uncertainty side which deters investment from going forward. And that's the one that we focus on and work with governments to try and attenuate as much as possible.
Keeping with that as well, we're talking about governance, is reforms within public institutions and governance structures. One of the things that the IMF does, or is known for, is capacity building, which does have a lot of impact on the debt sustainability of these countries. So for instance, record keeping of transactions in the treasury, operations in special accounts for public enterprises. These are things highlighted in the report. We've had issues in Mozambique, for instance, where about $2 billion of debt, there was a discrepancy there. What is the IMF doing in terms of capacity building? And more importantly, what is the response that you're getting from respective governments in terms of your...
So, Chris, this is a little known aspect of our work, but a good third of our the IMF's budget goes towards capacity development and things that are not particularly sexy, but we spend a lot of time with countries and provide policy advice on how to, for example, what's the optimal way of setting up your tax revenue office to collect as much taxes. So we have experts that go work with revenue agencies and identifying country-specific ways in which you can maximize revenue collection. The same thing in the public finance sphere, setting up systems which allow for the transparent recording of spending, frameworks for allocation of resources, budget preparatory processes. So we do a lot of technical work in that vein. And I think, it's perhaps the most demanded aspect of our work by countries, and it goes on quietly. The work that gets attention is the program dialogue we have, or the more high-level visits we do. So that's very important, and really, something which we offer all member countries. In terms of public finance management and governance, what our work does is provide you frameworks for the recording of spending, and it of course is ultimately up to the governments to make sure that they record the spending in their accounts. But one thing that our work does, and we do effectively, I think, is that particularly when we're engaged in a program setting, we try and push for as much transparency as possible. So the Mozambique case you cited is one where we, the presence of the program discussions brought out the fact that there had been this borrowing undertaken by the government. And also, as a condition for moving forward, what we ask for is an audit as to what the resources that were borrowed were used towards. So that's the kind of work we try and do.
Give me an evaluative context. Have you seen any progress in capacity development, the responsiveness from governments? Do you think there's a lot of accountability going on?
Well, I don't want to claim credit just to the IMF, but if you look at the evolution of the structure of ministries of finance, central banks, and compare them over the last 20, 25 years, a huge sea change in the way policy is formulated in the region. Very high levels of inflation, very poor monetary policy management, fiscal deficits that were out of control were par for the course in the region. But reflecting the better institutions, political institutions also in the region. But the quality of policy making in the region has been a sea change. So our governments do deserve credit. Of course, by no means is this a uniform story across the region. It varies quite a lot. But I would say there's been a big improvement in both the quality of policy making and, importantly, in the outcomes also. One thing we fail to do as an institution is draw the link between the growth that we celebrate to the policy environment and outcomes. And if you look what has happened over the last 25 years, the improvement in really very tangible measures of well-being like life expectancy, infant mortality rates, maternal mortality rates, that's what we're ultimately talking about. And there's been a huge improvement in those outcomes.
Speaking of central banks, let's touch on monetary policy. Your report seems to favor, or at least encourage, free-floating exchange rates by central banks.
Well, just to correct
me if I'm wrong. Mm-hmm.
The choice of exchange rate regime is up to the government.
Yes.
Okay. So we work with what regime governments choose. What we highlight is kind of whether the policies that have been pursued elsewhere are consistent with that regime.
Okay.
So just an important point.
You also then, if I'm correct, recommend more countries to follow explicit inflation targets, or again, that is subjective to central banks?
What we do, and I think there's a broad consensus in economics that, lower levels of inflation are better.
Desirable. Mm-hmm.
So I think that's a broad consensus. Whether that rate should be 2% or 7-8%, that's up to a country's central bank.
And how do you suggest countries deal with growing parallel exchange rates on informal markets?
Okay. So so this is basically the emergence of parallel foreign exchange markets, black market premiums, various phrases for this, is often a sign of a shortage of foreign exchange, of
yes.
course, through the official channels. And in general, it's desirable to have a single liquid foreign exchange market. The emergence of black market premiums often leads to inefficient allocation of the very scarce resource, foreign exchange, and often gives rise to governance problems, corruption problems. So, in general, you want to reduce the emergence of that.
Mm-hmm.
Sometimes our countries think that applying controls to the official exchange rate regime is a solution, but often that is addressing a symptom rather than the cause of the exchange rate difficulty that you have. So,
what tends to be the uniform cause of foreign currency shortages?
Well, there's no uniform cause, but in general, kind of, basically it's.
By uniform, I tend to mean like in Nigeria, there's a shortage of foreign currency. In Zimbabwe, in Zambia, as in it tends to be typical of Sub-Saharan Africa not to have adequate foreign currency.
Well, I think in all three cases, there are particular circumstances. So, like in Nigeria, for example, they were hit by this huge decline in commodity prices,
mm-hmm.
and the exchange rate wasn't allowed to adjust that loss in income immediately or to a full extent.
Mm-hmm.
Eventually, they've created a system which now has reduced the imbalances that they have in the foreign exchange market. So the gap between the parallel market and the official market has narrowed. So things are better than they were last year when the
yes.
gap was really wide. So they're moving in the right direction toward, and hopefully in the direction that will unify the exchange rate. In Zimbabwe, I think, of course, you're moving from very, a dollarized system, and the driver here is more, I would say, the fiscal pressures that you see in the economy. I think is the main driver, really, and generally the business environment has been weak, hasn't fostered a lot of economic activity and exports. So I think combination of those two are the driver of foreign exchange shortage.
Okay. Why we spent ample amount of time on that is, if we're going to talk about export diversification, we're looking for a lot of investment, and most of that tends to be from multinationals setting up or sending capital inflows into the country. But currency risk remains a significant factor, which is deterring a lot of investment in the continent, hence the focus on currency. Governments as well have increasingly relied on domestic banks and non-banking financing, which some governments have been flooding their markets with treasury bills and basically public guaranteed debts. Can you explain from an IMF's interpretation what this bank sovereign nexus is and the risks it poses to financial sectors?
So, one concern that we have in some countries is that, as you pointed out, as debt levels have gone up or fiscal deficits have been on the high side, what governments have tended to do is finance this domestically from the banking system.
Yes.
And so you have, if debt continues to increase and if this continues to go on, basically, you could have a problem if the government were to be unable to service its debt. It would hit the bank's balance sheets in a very severe way.
Mm-hmm.
So, just the concern we're highlighting really is a manifestation of all of the problems that an increase in debt can have, which is not just on the fiscal side but also on the financial sector side. So that's what we're highlighting.
A trend which also seems to be going on is basically deterioration of correspondent bank relationships. and this was highlighted in your report as well. What compromise does that do, particularly to the private sector and entities functioning within respective macroeconomies?
Okay. So the most direct impact of this loss of correspondent bank relationship is increasing the cost of transactions, particularly vis-a-vis abroad. So again, going back to what I said earlier, I mean, we need to look for ways of reducing the cost of doing business in our countries, the cost of transacting with companies abroad, entities abroad. So anything that goes in the way of instead increasing cost, of course, can be harmful. This is to a large extent due to the de-risking that foreign banks are taking, actions that are taking, rather than something that has been induced by countries in the region. So
it's an external factor which is impacting, the
yes. So the key really is to minimize this, to make sure that we have the systems, domestic systems are consistent with the appropriate anti-money laundering and countering the financing of terrorism.
Why that's a key point is because where the global economy is going, we're looking at a lot of convergence with globalization. And one of the key points which relates to what you're saying right now is the idea of conformity with, so take for example the Bank of International Settlements. It may have certain banking regulations such as Basel III. Most of our central banks are still trying to abide by Basel I, but there's that difference. How does that affect inter-regional or global commerce?
Okay, so there are several buckets there. I think one bucket is the framework for bank supervision and regulation.
Mm-hmm.
I think there's recognition and acceptance that the same type of regulatory framework that you have in the advanced countries is not appropriate for most African countries. So there is so the supervision and regulatory structures that countries apply here are consistent for the most part with what makes sense here. Then another bucket is the issues that you raised on the steps that are happening in the correspondent bank relationship angle. I think it ought to be manageable going forward. The risk, yes, it is raising the cost of transaction, but it is not what I would call a first-order source of integration. Well, it's not a first-order barrier to African countries' participation in the global economy. Yes, it's a hindrance, but something that can be overcome. But I think fundamentally for our countries to do better, really, it's getting our domestic policies appropriate. That's what we can control, and getting a vibrant business environment to facilitate domestic investment, I think, is key. Pursuing monetary and fiscal policy that doesn't deter or cause problems, the kind of pressures that we've seen emerging on the debt side, on the monetary and financial sector side, is another important aspect of policies. If we lay this framework appropriate and then do the more positive things like intervening in areas where we can promote export diversification, I think that will set most of our countries on the right path for progress going forward.
You're watching Millennials. I was talking to the Africa Director for the IMF, Mr. Abe Selassie. Sir, thank you for being on our show.
Thank you for inviting me.